Good morning, everyone, and welcome to the third and final day of Red Cloud's 2021 Oktoberfest Fall Mining Showcase. I'm David Talbot, Managing Director and Head of Research here at Red Cloud Securities. Keith Bowes, Managing Director of Lotus, is kicking off the day for us today. Lotus is preparing to bring back the Kayelekera mine, uranium mine in Malawi back into production, and they recently picked up another 6 million pounds in a satellite deposit. So Keith, you'll have 10 to 12 minutes to discuss, and then we should have a few minutes at the end of the session for Q&A. Attendees, please feel free to ask questions using the Q&A link. Take it away, Keith.
Excellent. Thank you very much, David, and welcome everybody to my presentation. So as David has mentioned, my name is Keith Bowes and I'm the Managing Director for Lotus Resources. Lotus Resources is an Australian company that owns the Kayelekera uranium mine, which is located in Malawi in Central Africa. Lotus Resources acquired the asset of Paladin Energy in March of last year, and therefore has held the asset for about 18 months or so. What was it that attracted us to Kayelekera? Well, I've listed out a couple of points over here, which I think is really important. The first of all is the team behind Lotus recognized that Kayelekera is a proven uranium producer. So it operated between 2009 and 2014, and in that period produced about 11 million pounds, all of which was accepted by the Western conversion facilities and by utilities in the US, in Europe, and in Asia as well. So therefore, from a marketing perspective, when we go out to go and enter into contracts with the various utilities, we know we're dealing with a known product for them, and we believe this gives us a leg up compared to some of our peers. We also recognize at the same time that Paladin spends about $200 million on building the Kayelekera asset. Now, when we look at the nameplate capacity of this asset, it can produce at around 3 million pounds per annum. Lotus's restart strategy is to operate the plant at around 3 million pounds per annum. We have no intention of actually increasing the capacity of the plant, and therefore from a capital raising requirement or a capital amount that is required to restart the asset, there's not a lot of money required. We are only required to refurbish the plant rather than expand the plant. And based on the scoping study that we did last year, it looks around $15 million will be required to refurbish this plant. Other things that were of interest to us when we were having a look at the project is we have been uranium bulls for a number of years now, and we believe that the companies that will be able to take credit or be able to benefit from the next uranium cycle are companies that will have assets that have been in care and maintenance and can be easily brought back online in a relatively short period of time, and Kayelekera fits that bill. We also recognize that when we did a review of the historical databases associated with the mine, there is some significant exploration upside that we can use, so we can build on the existing 37.5 million pounds that we already have in resources. And then just as a final comment on Lotus, Lotus is in a strong financial position at the moment. We have around 28 million Australian dollars in the bank as of the end of June, and that is sufficient funding to see us through until the end of next year. I just really want to quickly touch on some of the marketing or some of the uranium market themes at the moment. In our opinion, we're in a perfect storm at this stage. There are a number of short-term, a number of medium-term, and a number of long-term catalysts out there that are impacting on the price. And if you have a look at what's going on at the moment, obviously in the short term, it's the spot physical uranium trust that is having the biggest impact on the spot price at the moment. Prior to spot coming on the market in the middle of August, the spot price ranged between about $30 and $32 per pound. Since they've come into the market and started their aggressive buying approach, we've seen the spot price increase to as high as $51 per pound, and it's sitting around the $48 to $49 per pound at the moment. So from a short-term perspective, spot has a significant impact on it. But we also recognize there are some other catalysts out there that have more of a longer or medium-term impact on the price. And those are the things like the zero carbon baseload that uranium can provide in terms of power going forward. We also recognize there is an electrification revolution going on. We're seeing the number of electric vehicles being manufactured, being purchased, increasing significantly over the last few years and expected to continue to grow into the future as well. When we start to have a look at some of the forward-looking data that's available from corporations such as the World Nuclear Association, even under some relatively conservative assumptions, we recognize that there is a 30 million pound deficit in the uranium supply in 2024, and that this grows to around 60 million pounds in 2028. In some of the preliminary discussions we've also had with utilities, we recognize that a number of utilities entered into long-term contracts in 2009 and 2010. And some of these utilities have either come off those contracts or are in the process of coming off those contracts. Now, with the increase in the spot price in the last few months, our expectation is that these utilities will want to re-enter into term contracts within the next couple of months or so, being a much more secure or a much more confident way of confirming the price for the uranium that they want. Maybe just as a last comment as well, in terms of pricing, I think the Kayelekera asset fits well in with the other assets out there that are sitting either on care and maintenance or even some of the greenfield assets, and that we believe that the current pricing is probably still a little too low to encourage new production. We would still like to see the spot price increasing, and more importantly, we would like to see an increase in the term price prior to making any decision to bring our asset back online again. I'd like to talk quickly about why we think Kayelekera is important and our commentary around why we think companies that have assets on care and maintenance are the ones that could potentially benefit from the new uranium cycle coming forward. So the companies that have assets that are on care and maintenance are more likely to be able to bring the assets back into production in a relatively short time frame. And when globally, when you have a look around and see what are the companies that currently have those assets, there's really 6 of them out there at the moment. You have Cameco with their McArthur River and Rapid Lake. You have Paladin with the Langer Heinrich project in Namibia. You have Lotus Resources with our Kayelekera project in Malawi. And it's important to note that of all the assets that are currently on care and maintenance, the Kayelekera asset is the 4th largest producing asset. So the 3 million pounds that we spoke about places Kayelekera as the 4th largest producing asset currently on care and maintenance. Other companies out there that should also benefit from the cycle include Energy Fuels, Boss Resources, and Peninsula Energy as well. Again, what was noticeable to us is when we did this comparison against these peers, and you have a look at Lotus's market cap. Today, our market cap is just a little above $240 million US, which is relatively low compared to our peer group. Paladin sits at 1.7 billion, Energy Fuel around 1.1 billion, and Boss Resources at $470 million. So we believe there's significant upside to our share price moving forward. I'll just talk a little bit more about the project now. So as I've mentioned, it is a proven 3 million pound per annum producing asset. We have all the infrastructure on site required to operate. We also recognize that since the asset was put in care and maintenance in 2014, there have been some technologies that have come through and processes that have come through that could have a significant impact on the process. And we believe by implementing those processes, we could improve the economics of the project as well. We have our licenses in place, and we have our environmental license in place already, and our mining license was renewed for a further 15 years last month. We also have a number of permits in place, and there are a small number of permits that we still require before starting the plant back up again, but these are relatively minor and relatively simple to collect. And as I also mentioned, there are some near mine untested targets that we believe we can use to increase our resource as well. I just want to talk a little bit about how we see our pathway to recommencing production at Kayelekera. For the first thing is we put out a scoping study in 2020. And based on that scoping study, we were able to run some sensitivity analysis that identified what we think were the key cost drivers and the key value drivers for the project. And our assessment showed that things like ore sorting, the source of the power for the plant, the existing plant at Kayelekera runs off diesel gensets. If we were able to get power off, for example, the grid or from renewables, we believe we can reduce our power costs significantly, which would have a big impact on the project. We also recognize that acid cost and acid consumption is a significant contributor to our C1 costs. And there's some technologies out there, some processes out there that we can use to recover acid and to make better utilization of the acid. And then the last one is around tailings disposal and some opportunities around there to reduce costs. So we've been busy working in these 4 areas. We've made some good progress on them. And the idea is that the results from these 4 different studies that we'll be doing will be then used in the feasibility study. We announced the start of the feasibility study to the market about a month ago, and we expect to be able to deliver the feasibility study and the associated results to the market in the middle of next year. We'd really just like to touch a little bit on ore sorting because it is an important part of our restart plans. But I must emphasize that we're not using ore sorting to convert an uneconomic project to an economic project. The project as it stands now is economic, and we're using ore sorting technology to finesse and to improve the economics. The most important thing about ore sorting is it allows us to increase our grades being fed to the main plant. And the test work that we have done so far has shown that we could take a 1000 ppm material, feed that into the ore sorting unit, and produce a concentrate that has around 2000 ppm in it. Now, what does this mean for the project? Well, the one thing we can use the ore sorting technology to do is to ensure that we're able to produce at the nameplate capacity of 3 million pounds per annum. But probably more importantly, what we can do is use the ore sorting technology to convert some of the lower grade stockpile material that runs at around 350 or 400 ppm, put that through an ore sorting unit, increase the grades to around 700 or 750, and we know that becomes a very, very economic feed for the plant. So by doing this, we're able to extend the life of the mine as well. We also recognize at the same time that by using ore sorting, we can decrease our operating costs as well. The other one I just want to quickly touch on is regards to some of our exploration work that we've been doing. So 2 months ago or so, we announced the start of a 5,000 meter RC drill program, which is focused primarily on extending the Kayelekera resource. That program has come to an end now. We have sent the samples down to South Africa for assaying, and we'll be able to report on those in the next few weeks. The drill rigs have now gone up to Malenji Hills, which is about 2 kilometers north of our existing pit. There's an interesting rare earth anomaly there that we would like to investigate a little bit more, see whether there'll be some potential to generate some extra value for the company, either by developing that ourselves or potentially going into, say, some JV with a partner, or even alternatively, maybe splitting it out into another company. David made a comment as well in the presentation that as part of our review of our historical databases and also the other information available in Malawi, we also announced last week the acquisition of the Livingstonia tenement. The Livingstonia tenement has a historical resource on it of around 6 million pounds. We plan on sending our drill rigs down there after we have completed the Malenji work to look at potential extensions there, as well as some QA/QC drilling such that we can then convert that into a JORC 2012 compliant resource. So really just to summarize then, why do we believe Lotus is positioned, well positioned for the next uranium cycle? Well, it is a proven producer that's produced 11 million pounds. It's been accepted by all of the conversion facilities. We are in a strong cash position until the end of 2023. We believe there's some significant valuation upside, both when you compare our market cap against our peers, but also with the work that we're doing around exploration, our technical studies and our feasibility study, we believe we can add value to the company. We have a very experienced board and management team in place that has extensive African and uranium experience. And because we already have the existing infrastructure there, and our scoping study demonstrated that we probably need around $50 million to restart the asset back up again, if you compare that to our current market cap, we believe raising the $50 million is going to be a relatively simple operation for us to do. So David, that's the end of the presentation, and I'm happy to take any questions.
Okay, thank you very much, Keith. Those key cost savings initiatives that you're talking about prior to restart, how much of an impact on operating costs might you expect from these? And I understand the studies are ongoing.
Sure. So I didn't touch on it in too much detail, but within the scoping study, we demonstrated that under a high-grade scenario, we were able to produce at about $33 per pound was our cost when we were producing at 2.4 million pounds. Now, if you have a look at the ore sorting capacity or capability in terms of increasing that to 3 million pounds, you have a look at the potential savings that we can get by moving away from the diesel gen sets and looking at connecting to the national grid and also using renewables and some other opportunities, and the acid savings that we can potentially get by using such things as nanofiltration, and that we believe that we can reduce our operating costs by at least 10 to 15%. So we would expect to see our C1 costs in the 28 to 29 sort of range. And we'd also expect to see our all-in sustaining costs drop down to maybe $34 or $35 per pound. So those are sort of the targets that we have in mind for our feasibility study.
Okay, and your ore sorting technology, is that going to allow you to pick up some more of these modest grade satellite deposits like Livingstonia?
Correct. I mean, that's one of the things that we first of all had a look at when we went through the process of looking at the Livingstonia resource. It is 6 million pounds, but it is relatively low grade, around 350 ppm. It's about 90 kilometers away from the site. So it wouldn't be economic for us to truck the material from Livingstonia to the Kayelekera mine site. But if we were to implement ore sorting technology at that satellite pit, we believe we can take that 350 ppm up to 700 or 800 ppm or something like that. That then becomes a very economic ore for us to truck the 90 kilometers to the mine site. So definitely ore sorting technology is affecting how we're thinking about the processing, but it's also impacting how we're thinking about our exploration strategies as well. We believe there's a lot more material out there of the lower grade, then perhaps, the higher grade stuff is much more difficult to find, but obviously the lower grade material, we think there's some real opportunities there for more discoveries.
Okay, fascinating. Great story. Thank you very much, Keith, and thank you everyone for joining us today. Up next, we have grid metals.